Welcome to the Money GPS. You came here for the truth, so let me unveil that for you. Today, I've got an interesting one. We're going to look at things on a different level. If you stay with me until the end, I will show you what's going on in the financial system. I'll show you what's happening with the analysts and what they are saying in this market today, and then I will give you an overview at what's happening with the economy as it relates to inflation. Let's begin by taking a look at your friend, Jim Cramer, Jim Bear Stearns Cramer. Well, in this one here for his investing club, he said at the end of this, basically, you want to be in oil. You want to be in oil. Well, apparently the inverse of whatever he says is true. So this could be a concern for the price of oil. But no, seriously, what he was talking about in here was that you want to be with the big names, the solid names, and that's always the case. People were investing in things that were absolutely ludicrous, and then we saw the price falling down considerably. I'll show you more about that in a second, but the point here is that we must make decisions for ourselves, not because Jim Cramer or whoever it is that people are interested in are the ones that are telling you why. Because how many people on YouTube and how many people out there are doing pump and dumps? How many times does this happen? We hear about it all the time. And people can make excuses left, right, and center. Oh, no, it wasn't the case. But it happens all too often. So be very careful at what you are looking at, what you are investing in, and make the decision for yourself. Now this right here, apparently Janet Yellen, your friend and mine, actually just my friend, but anyway, Yellen said, now there was a rumor that Yellen had said, no, we don't want this big, huge package, the American Rescue Plan. We don't want it to be massive. We want it to be scaled down. But actually, Yellen said, I never urged adoption of a smaller American Rescue Plan package, and I believe that ARP played a central role in driving strong growth throughout 2021 and afterwards. Because what's happening here, as we have seen all throughout, it's that these massive infrastructure bills and all the different stimulus packages and everything ultimately do a great job temporarily. Let's get people spending, let's throw out cash. Oh yeah, absolutely. But what happens at the end of the day is that you create inflation. You create major inflation. And now basically everybody's agreeing with that, but they say, well, we had to do so. I'll tell you what's wrong with this photo right here of Janet Yellen. Can you tell? Can you figure it out? Take a look. What's wrong with it? I know. She's not giving a thumbs up. Don't make the same mistake as Janet Yellen. Hit that thumbs up to support the channel. It's right down there. Now look at this. If you remember this tweet from 2017, actually, it was one of the funniest I've ever seen, and I wanted to remind you of it. This is Stephen Munchkin, okay? Thanks to the U.S. Mint staff for hosting at Fort Knox, first U.S. Treasury Secretary to visit since John Snyder in 1948. Quote, glad gold is safe. Now, if that's not the most generic and suspicious message after apparently going there to, it's not even an audit, it's just a, hey, I went, then I don't know what is. Look, the financial system, the way that it was previously designed, even with fractional reserve, that's gone. There's nothing but an idea left. And ideas are great. Ideas are fantastic. But eventually, at some point, that crumbles to dust. So watch out where your money is, where it's being kept, and all of the activities that you do and you are spending time on, make sure that they are diversified because we're in for some big changes. Cotton has outperformed, quote, disruptive innovation since ARK's inception. So when the ARK, and this is just ARK, not to bash this particular ETF or the company or Cathy Wood or anything. It just shows us that, look at it, since 2015, okay, we have these innovative stocks and things are, supposedly going to do so well and all this. And ARK goes ballistic. It far surpasses cotton and any other commodity that you've seen. But what has happened here? It's that it has come back down to earth. Now, do you want to ride that? Or do you want something that is just going to go up and up and up over time? Maybe that up and up over time is because of the devaluation of the dollars. And so nominally it goes up. There are other reasons for it, of course, shortages and problems, of all kinds. But you can see that this here, this wild, absolutely wild roller coaster is not because of disruptive innovation. It's not because of quantitative easing. It's because of psychology, and it's because of euphoria and mania and all that. So we must be aware of this when we do our investing. Are we investing in this because that YouTuber said to? Because or should I say, because he said he's buying it? Or am I investing in this because this is the greatest thing since sliced bread? Now, speaking of, commodities, well, we've got one here. I believe they make beer out of hops. Do you make it out of wheat? What is it? I don't even know. Price of a UK pint is up more than 70% since the financial crisis. London pubs charging up to £8, with more rises to come as the cost of beer, there you go, barley, ingredient barley, jumps. Okay, why? Because they're getting that commodity from a place that suddenly is disrupted, and now they have to charge more to their customers. The customers can only take so much. Inflation divide, the wealthy splurge, the poorest pull back. And we see this all the time. That's why I keep talking about things like art, collectibles, and the extreme housing, like an apartment for $200 million, Ken Griffin buying it up. You see this all the time, right? And it's unfortunate. Inflation benefits the very tippity top, and it hits everybody else. Now, we have some, I don't like to call news good or bad. I think news is neutral. But anyway, Beijing opens up restaurants, cinemas, as China continues easing. So they're opening up. Beijing, Shanghai, and there was actually 50 to 100 cities doing one form of lockdown or controlled measures in some way. And that is starting to dissipate, which for the global economy, for consumption, for moving products in and out, this is a good thing. Okay, so I just wanted to give you an update on that as we move through. And if we look really quickly here at some factors in the markets, because this is what I told you was coming in this episode, and you got to understand all this, okay? Look at it. The Federal Reserve unquestionably is the most important factor right now today. If you want to just distill it down, like what's the one thing? What's that one thing? Well, this is it. Specifically, interest rates, money printing. If the Federal Reserve is pumping, speaking of pumping, people are going to be seeing massive gas increases. It looks like we're going way higher on that. But anyway, if they continue to pump, that devalues the currency, and that creates essentially liquidity into risk assets. Tends to be stocks and other things. If they pull it away, we get a big change. Fed took real rates to greater than 4% in 2000 and greater than 3% in 2008. They're talking about the 10-year, by the way, 10-year. Right now, where are they going to be able to get this to go? Are they going to stop this cycle right now? I just don't know. I don't know how far they can get. Look at right now what's happening with the global markets. You're seeing global equity fund flows massively, okay? Weekly fund flows, $21 billion fund flowing globally. But what's interesting to note about this, doesn't show it here, but I know this, that almost all of that is going to the US. So the US is considered in some way to be a safe haven in this regard. The US dollar, but also the US stock market. Now, safe haven meaning, when we compare Europe, when we compare Japan, when we compare, their investors see that as the place to put it, but they might take their money from the US dollar, they might want to move it into gold later. But we need to see extreme fear, not not the fear and greed index type of fear. We need to see like, okay, the end of the world type fear, for then you just see a massive surge in things like gold and silver. But until that extreme fear is in play, you're not going to see the paper gold markets move up. Physical gold, we know already, huge demand, there always is. US share buyback authorization announcements, essentially how many companies are buying back their shares, and there is an expectation that there will be a record high. What does that mean? That means the biggest buyer of stocks is going to be extremely buying back their stocks. Doesn't make sense, but you know what I mean. And then we have this. What do you do when you have a problem with the amount of workers you have, with the amount you have to pay them, with the sick days, with people being worried about coming to work, with unionization and all this? What do you do with that? Well, you fix all that? Do you resolve all that? Or do you turn to robots? Busy factories are turning to robots to pick up more work. And I've shown examples before on here that say specifically that they dialed it in so good at their factory that they were able to remove almost all employees. They still needed some employees, but remove upwards of 95%, I think it was, and their efficiency increased to like 99%. So they basically said, this is fantastic. That's what's happening. I think one of the best possible jobs is going into producing or fixing the robots. I think that's going to be the next trend personally, but that's just based on, trend analysis. And you can see right here, they just, they get into that and basically saying, look, they don't need to take a break. They don't need to, they don't get upset. They just keep working. And that's just the way it goes. That's the future, it seems, that they want to replace as many of the jobs as possible from a business standpoint. Don't forget about it from the top down. Just looking at it on any individual business. They say, how do we increase productivity? How do we get something that can work 24 hours a day? These people won't work 24 hours a day. Oh, I know, robots. So they want to automate as much as possible. That seems like the way it's going. And what does that mean? Ultimately, less people working in these type of positions. So the rate at which this happens is the biggest concern because it's happening really rapidly. If you appreciate this information, simply hit that thumbs up button. These are some different trends, but it all connects in together. I want to thank you for doing so. I'm giving you a thumbs up as well. And don't forget, we are at 282,000 subscribers, and we are going to go all the way to 282,000 subscribers. Join me here by clicking that subscribe button, and I'll see you on the next one. Take care.